Hello, this is webinar from Better Trader. My name is Eyal Moore. This webinar will be about the risk of real-time monitor, the idea behind the index and how to use it and how not to use it. I will start with general information about Better Trader. The idea behind Better Trader is to support day traders, not to miss opportunities and not to get caught in stop loss because some unexpected events happened and they didn't had the time to react or didn't had the analysis ready for them. And on top of this framework, we built many tools which hedge funds and professional traders to support the everyday trader to navigate much better and in more successful and informed way in the financial market for intraday trading. It means it could be from 1 minute, 5 minutes trade up to 4 hours. So it should help you during the day. Now the risk of real-time monitor. The idea behind the index is to help you to gauge the mood in the market. There is days that all the markets in a good mood. There are days when all the markets in a bad mood. And there are some days that there is not real direction in the market, and you don't really want to be in the market when there is not a good um direction, and you for sure don't want to be against the market when everyone is positive today and there is like good mood. You don't want to try to short S&P 500. It's not helpful. Now let's try to see how it's built. The risk index measure the flow and momentum between different asset classes. So in general, when the market is positive and there is a good mood, traders sell gold, buy S&P, buy oil, sell government bonds. All of these represent positive mood in the market. So each component here showing you the positiveness or negativeness in the mood right now. So oil, it's kind of not so positive, not so negative. Gold represents some positive mood in the market. It means that gold probably is going down and not up. So we will see like gold and then this trend down with the gold. This what you see here, this representation of positive, because when gold is moving down, it means that there is money flow out of gold. It means that people not looking for safe havens, they're looking for more risk on assets and things like this. The idea of each one of them is to let you know what this market addition or contribute for the mood in the market. When this here is the aggregation of all of them, so it's kind of the risk index, and you can see how it's behaved over time. For example, in the last 1.5 hour, and you can see here ST is the standard deviation. It's how much this all in the same direction. So in general, the lower this number, the more reliable this number. So now this is 36. If we will in 1 hour, we'll see it to be like 12. It means that all the risk basket behave in playing the same music, negative or positive. Now, how you can use it? First of all, here you can see like the risk index, and you can see this. This is like the standard deviation, but let's remove it, and let's say that you trade S&P 500 and oil and gold. So this is gold. So you can see gold is become positive here, and the S&P 500 was down, and maybe even it was a good opportunity to see the gold going representing positive, and S&P a little bit dragging behind, and then S&P join. But this is just like a micro example how you can use this logic. The idea is that you don't want to short this when it's above 17. So you don't want to bet on a bad mood in the market when the risk index is trending higher. And for me, I like to see it like more than 20, and it's like pretty good opportunity um, to catch up some lagging market or some buying some markets on support level. For example, let's assume S&P 500 with support level here, and this here will cross 20, 15, 20, and they see that there is some good mood in the oil and so on. Maybe it's good opportunity to purchase S&P 500 and get some um, upward pressure that will upcoming soon. So it's help you to understand the mood in the market. When here it's more than 25, I'm not going to short S&P 500 because it's mean that all the markets is in a positive mood. Here, so you can see all of them together, and now there is like the risk insights, which this is more about to give you a reference what's happened after. We're generating risk insight all over the day, like the market's trending positive or negative. And here, for example, you can see the risk index was trending negative below 25 point. So when this was minus 25 point, we generate this insight to let you know. And this is the reference point here. And now um, we're not now, like we lock this 60 minutes. So 60 minutes following this event, the risk index was minus 11. It means that it's recovered a lot. And let's say before, this is from yesterday even, the trending positive about 25. So let's see what's happened 1 hour after. It was in the same place. And you can see all the range, what's happened in this hour. So you can even learn how the market behave. You see, like it's here, it's end minus 11, but it's went down until minus 38. So this is like time frame of 1 hour after the moment of this insight generated, and you can see the minimum point that the market was in the positive. So the market went down, like the mood went down much more lower and then rebound. And in this way you can see like how the market reacted after such and such events. This is too old, so you don't have it. It's yesterday morning, but that's the idea. You can see here the range after some time, and what it's locked after 1 hour, so you can get some sense how the market could react after it reached some level of positiveness or negativeness. When you will see that the risk index is crossing 45, extremely positive, you can watch this meter to see what happened next. It's not giving you like an immediate reaction what to do in the market, but it's giving you more like understanding when you see here what to do, how to behave, and so on. Now you see this is more than 21. S&P is here a little bit rebounding, but let's say this is like a support. It's pretty, it makes sense that the market can come to here if this is continue to go up. Oil start to be positive, so start to develop some positiveness in the market. I wouldn't try to short S&P 500 right now. Of course it can and could go down, but I wouldn't try to short it when I see this development become like positive. I can buy it here and say, okay, this is my stop loss under this support level. So the idea is to combine the risk index with trade ideas, with your way of trading, with support and resistance levels, and so on. You have the basic, regular, and extended market. If you trade S&P, basic and 4 hours is the best setup for intraday. And I think that this is for now. Let us know if you have any question. You're welcome to get here in the chat. We will be happy to help. Thank you very much.